Tilray Brands, NASDAQ TLRY, currently trades at 1.38, reflecting a 0.09 or 6.12% drop on the day, and it's far from its 52-week high of 1.88, while still well above its 52-week low of 0.35. This intraday movement might seem like just another blip on the notoriously volatile chart of a cannabis stock, but to view it as such is to miss the far more consequential, under-the-radar developments that are quietly reshaping this company's entire narrative. While the market remains fixated on the traditional cannabis-centric story, a perpetual wait for USSO, federal legalization that feels more like a mirage than a catalyst, the real transformation at Tilray is happening on a completely different front, a stealthy and aggressive diversification strategy that has quietly turned the company into one of the largest craft beverage alcohol companies in the United States. This isn't just a side hustle. It's a fundamental pivot that is de-risking the business and building a robust, cash-generating enterprise, while the rest of the sector remains mired in regulatory purgatory. The expectation is that Tilray is a pure-play cannabis stock, a binary bet on federal reform. The reality, however, is that it is rapidly becoming an international consumer packaged goods, CPG, conglomerate with a cannabis segment, not the other way around. This distinction is critical and represents the single most important reframing investors must adopt to understand the true value proposition of the company. The market narrative for Tilray has always been simple. It's a Canadian cannabis giant poised to pounce on the U.S. market once legalization occurs. This expectation is a remnant of the green rush days when sky-high valuations were built on promises of a global industry free from legal constraints. In that framework, Tilray's high-profile mergers and acquisitions, such as the one with Aphria, were seen as power plays to consolidate market share ahead of the inevitable. Yet, a deeper analysis reveals a stark reality. While cannabis remains a core part of their identity, the company's recent financials and strategic moves tell a different story. In its most recent fiscal year, Tilray's beverage business alone generated a significant portion of its revenue, growing sales by a substantial 19% year-over-year. This wasn't a minor contribution, it was a quarter of the entire top line. This is a crucial point of context. The company is no longer solely a cannabis player. It has effectively built a second, entirely separate revenue engine that operates under a different regulatory and market paradigm. The application of this is seen in its acquisition of brands like Sweetwater Brewing Company, which has a massive and established distribution network in the U.S. The framing here is profound. This is not about hoping for a future legal change. This is about building a business that can thrive in the present, using its beverage infrastructure as a U.S. optionality strategy. This dual-track approach, building a legitimate, profitable CPG business while maintaining its cannabis infrastructure, is a sophisticated gambit that few of its peers have successfully replicated. While competitors are burning through cash and pleading for regulatory relief, Tilray is generating revenue from established channels, strengthening its balance sheet, and creating a path to profitability that doesn't depend on the whims of politicians in Washington, D.C. This is the reality that challenges the prevailing simplistic expectation. Let's dive deeper into the financial and strategic architecture that underpins this new reality. The company's latest quarterly reports reveal a complex, multifaceted business that is far more resilient than its stock chart might suggest. For instance, while the cannabis segment may face persistent pricing pressures and a challenging regulatory environment, the beverage alcohol business is not only growing, but it's also generating strong margins. Tilray's beverage alcohol gross margin was an impressive 41% in the last quarter, a number that demonstrates the segment's profitability and its contribution to the bottom line. This stands in stark contrast to the often razor-thin margins and intense competition in the Canadian cannabis market. The company's strategic partnership with an Italian firm to expand medical cannabis access in Europe further diversifies its revenue streams, moving it beyond a purely North American focus. This is a macro-level insight. While the U.S. market remains the ultimate prize, international markets, particularly in Europe, are offering more stable and predictable growth opportunities. On a micro level, Tilray's leadership, specifically CEO Irwin Simon, has been very clear about this strategy. They are not waiting, they are building. They have been aggressively expanding product lines, from hemp-derived THC beverages to new medical cannabis strains, and their recent public statements focus as much on their craft beer brands as they do on their cannabis portfolio. This dual focus is not a distraction, it is the core of their business model. The company's balance sheet, with over $256 million in cash, is a testament to their focus on capital preservation and strategic deployment. They are using their resources to pay down debt and fund acquisitions that immediately contribute to the top line, rather than pouring money into a speculative market that may or may not materialize in their desired form. This deliberate, methodical approach stands in stark contrast to the speculative spending that characterized the early days of the industry and marks a new, more mature phase for the company. The narrative of Tilray as a risky, speculative bet is giving way to the reality of a company with a clear and executable strategy for sustained growth. The second, and perhaps even more compelling layer to this story, is the subtle but significant shift in the regulatory winds that investors are largely misinterpreting. The prevailing expectation is that U.S. federal rescheduling from a Schedule I to a Schedule III substance is a holy grail event that will instantly transform the entire sector. While this is certainly a powerful potential catalyst, the reality is far more nuanced, and Tilray is uniquely positioned to capitalize on it in ways its competitors are not. A Schedule III reclassification would primarily address two major hurdles: Section 281 of the IRS tax code, which prevents cannabis businesses from deducting ordinary business expenses, and the restrictions on banking and research. The market expects this to unleash a flood of cash and growth for all players equally. But here's the contrarian take. The true winners will be the companies that can move fastest and leverage existing infrastructure. Tillray, with its established U.S. beverage distribution network, already has the logistical backbone in place to scale operations and bring products to market the moment regulations permit. It's one thing to have a cannabis product. It's another thing entirely to have the trucks, the warehouses, and the retail relationships to get it on shelves across the country. This existing network provides Tilray with a massive competitive advantage, a kind of pre-built launchpad that others lack. The framing here is essential. A potential regulatory change is not a rising tide that lifts all boats equally. It is an opportunity that disproportionately benefits the most prepared. Furthermore, let's consider the European opportunity. While U.S. regulatory reform dominates the headlines, Tilray has been quietly and effectively building a leading position in the German and Italian medical cannabis markets. Germany's recent move to legalize recreational cannabis for adults, even with its complexities, signals a broader shift in policy across the continent. Tilray's strategic partnership with Molteni, a major Italian pharmaceutical company, gives it a significant advantage in distributing medical cannabis extracts and leveraging a well-established network in a country where medical use is expanding. This is not a speculative play. It is a tangible, operational growth driver. The context is that European markets, while smaller than the U.S., offer a more predictable and often more lucrative regulatory environment for medical-grade products. This micro-level strategic insight shows Tilray is not putting all its eggs in the American basket. Its geographic diversification provides a critical hedge against the legislative gridlock and market volatility that plague North America. The market's focus on the U.S. has created a blind spot, causing investors to overlook the substantial and growing value of Tilray's international business. The financial performance of these segments, particularly the high gross margins on medical cannabis, reinforces that this is a smart, calculated move. It's a reality that directly contradicts the simple narrative of a U.S.-dependent, all-or-nothing bet. The company's management is deliberately building a global, multi-segment business, and the market has yet to fully appreciate the resilience and long-term potential this creates. In the end, the story of Tilray Brands is not what it seems on the surface. The market, clinging to the old comfortable narrative of a high-risk, high-reward cannabis pure play, consistently undervalues the company's strategic evolution. The expectation was that Tilray was just another cannabis stock, a binary bet on U.S. federal legalization. The reality is that the company has fundamentally transformed itself into a diversified consumer packaged goods powerhouse, with a significant and growing presence in the lucrative beverage alcohol market, a strong foothold in international cannabis, and an infrastructure poised for U.S. expansion that is far ahead of the competition. The stock's price movements, often tied to the latest rumor out of Washington, fail to capture the methodical, deliberate, de-risk,